Two people retire with identical $1 million portfolios in 2 different years. 10 years later, one of them has $1.4 million. The other has gone completely broke. Same starting balance. Same average annual return of 7%. Zero difference in strategy. The only variable was the order in which the market gave them those returns. One retired into a bull market, the other retired into a crash. And here's the thing that should genuinely disturb you. Right now, in early 2026, after 3 consecutive years of strong gains, including a 17.9% total return in 2025, the S&P 500 has encountered difficulties. The index is approximately 5% lower year to date and has suffered 5 straight weekly losses. Every person who retired in 2024 or 2025 is sitting in the chair of that second investor right now, in real time, without knowing it. There's a 2-year window at the start of retirement that functions like a detonator. Get through it in one piece, and you are largely fine. Trip the wire during it, and no amount of smart investing after the fact can fully fix what breaks. This video is going to show you exactly how that detonator works, the math, the psychology, the hidden healthcare bill no one builds into their plan, and 3 specific moves that change the odds in your favor before the clock starts. The conventional wisdom says retirement is dangerous because of inflation or longevity or not saving enough. Those are real. I'm not dismissing them. But they are slow-moving threats that respond to adjustments over time. The danger I'm talking about is different. It is fast, it is structural, and it operates in a narrow window where most people are simultaneously the most financially exposed they have ever been in their lives, the least psychologically stable they have been in decades, and here's the one that genuinely gets me statistically likely to have retired earlier than they planned. I'm going to walk you through all 4 layers of that. By the time we're done, you'll see your retirement window differently than any financial advisor has probably shown you. Think about a plane. For its entire life on the ground, every crew member is focused on one thing: fill the tank, add fuel, maximize capacity. Then one day, the plane leaves the runway. And from that moment on, the math inverts completely. It is no longer about filling, it is about burning. And here is the thing about burning fuel while flying. If you hit turbulence in the first 1,000 feet of altitude, while the engines are still spooling up and the gear is barely retracted, the consequences are categorically different than hitting that same turbulence at 35,000 feet in smooth cruise. That is retirement. The flip from filling to burning, and the first 2 years after that flip, that is the 1,000 feet of altitude. That is where everything that seemed theoretical during the accumulation years becomes terrifyingly real. I'm going to call this the fuel tank flip throughout this video because it keeps coming back. Every major financial mistake in early retirement traces back to people forgetting that they have flipped the tank. In a few minutes, I'm going to show you something about healthcare costs before Medicare that might be the single most underplanned expense in America right now. But first, let me show you why the order of returns is what actually determines whether your retirement survives. Here is what they taught you about investing. Average annual returns. 7% historically, 10% if you're aggressive. These numbers gave you a feeling of safety during the accumulation years. If the market dropped 20% one year and gained 25% the next, the average was roughly 2%. Not ideal, but survivable. You held, you bought more shares at a discount, you recovered. Retirement breaks that math entirely, and I mean that precisely. Take 2 people, Marcus and Linda. Both retire with $1 million. Both have an identical portfolio mix. Both achieve an average return of exactly 7% over the next decade. Same average, different sequence. Marcus gets strong positive returns in years 1 through 5, let's say 12%, 10%, 9%, 8%, 11%, then a series of down years later. Linda gets those same returns, but in reverse. She gets the negative years first. Both retire with a $1 million portfolio and withdraw $50,000, increased by 3% for inflation each year. Over the first 10 years, both portfolios earn the exact same average annual return of 7%. The only difference is the order of those returns. Lucky Larry, call him Marcus, retires into a bull market. He enjoys strong gains in his early years and his portfolio grows to over 1.5 million before a market downturn hits in year 8. The other retiree gets the exact same returns, but in reverse order, retiring directly into a bear market with immediate significant losses. In Marcus's case, the portfolio is still healthy and growing. In Linda's case, after those same 10 years, with the same average 7% return, she has run out of money. Not because her portfolio was worse on average, because of when the bad years arrived. This sequence of returns risks the danger of experiencing poor investment returns in the first few years of retirement, which can cause irreversible damage to your portfolio's longevity. The order in which you receive your investment returns matters more than the long-term average return once you start making withdrawals. This risk is most dangerous when combined with a high withdrawal rate, as it forces you to sell more shares at low prices, permanently depleting your capital. Morningstar's Amy Arnott, a portfolio strategist, calls the first 5 years of retirement the danger zone for tapping accounts during a downturn. Here is the precise reason it matters so much in early retirement, and almost not at all 10 years later. When the market is down and you are still working accumulating, you benefit. You buy shares at a discount. Cheaper shares means more future upside when they recover. The math works for you. But after the fuel tank flips, when you tap into your portfolio as it's losing value, you have to sell more investments to raise a set amount of cash. Not only does that drain your savings more quickly, but it also leaves you with fewer assets that can generate growth and returns during potential future recoveries. Every share you sell at a depressed price is a share that cannot participate in the recovery. You have locked in the loss permanently. The capital is gone. And then next month, you need cash again because you still have to eat, still have to pay rent, still have to cover that insurance bill. The probability of portfolio failure for a retiree who experienced a significant market shock at the point of retirement was 50.6% compared to only 33.5% for a retiree who experienced the same shock 15 years later. This quantifies the disproportionate impact of bad timing. So you think the problem is market crashes, but actually, the problem is market crashes combined with mandatory withdrawals. Remove the withdrawals and the crash is survivable. Remove the crash and the withdrawals are sustainable. It is the combination at the exact moment of the fuel tank flip that creates the failure. The actual maximum sustainable withdrawal rate over different 30-year historical periods has ranged from 4 to 10%, depending almost entirely on the market sequence a retiree happened to retire into. Not their strategy, not their discipline, their timing. The luck of the launch window. Stay with me here, because this next part is the one that nobody builds into their retirement plan, even though the data is completely unambiguous about it. You have a retirement plan, it involves working till 65, maybe 67, you've run the numbers. The 401k is on track. You just need those last 5 years of high salary contributions, and then you're done on your terms. Here's the most statistically likely thing that will happen instead. 46% of Americans who retired in 2025 stopped working earlier than they expected. According to the Employee Benefit Research Institute's 2026 Retirement Confidence Survey, 76% of those early retirements were caused by things outside the worker's control: health, layoffs, or caregiving. Let that land. It is not 46% of unlucky people. EBRI says 40 to 50% of retirees in any given year, going back to the late 90s, have said the same thing. This is not a rounding error. This is a structural feature of how Americans end their working lives. A 2022 Gallup poll revealed the gap with two numbers. The average person planned to retire at 66. The average actual retirement age came in at 61. That is a 5-year gap between plan and reality. 5 years of salary, 5 years of contributions, 5 years of employer match, 5 years of compounding that never happened. Now do that math. If you plan to work until 67 but left at 62, you did not merely miss 5 years of saving. You flipped the fuel tank 5 years earlier than the plan assumed. 5 fewer years of accumulation and potentially 5 extra years of burning. On a typical retirement portfolio, that can be the difference between a 30-year plan that works and a 30-year plan that runs dry in year 24. Of those who retired early, most pointed to health-related reasons, 46%, followed by employment issues at 43%. Just 21% said they retired early because they are financially stable. So the assumption baked into most retirement modeling that you get to choose the date is wrong more than half the time. You are not planning for a retirement. You are planning for a retirement that may happen to you suddenly, 3 to 5 years before you're ready, for reasons entirely outside your control. Layer that on top of sequence of returns risk. You leave the workforce early, not by choice, into a year when the market has just started declining. You flip the fuel tank ahead of schedule into turbulence. The plan assumes smooth cruise at 35,000 feet. Instead, you're fighting for altitude at 1,000 feet. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Retirement spending is dynamic, with 60% of new retirees seeing their annual expenses fluctuate by more than 20% in the first 3 years. According to JP Morgan Asset Management, not a small swing, 20%. In either direction, which means even retirees who modeled their spending carefully are operating with a budget that moves around dramatically during the exact window when stability matters most. The average retirement savings for all American families is $333,940. The median is $87,000. Only 5% of households with retirement accounts have $1 million or more saved. And even for those who do have a solid nest egg, the problem is not the amount, it is the exposure window. The fuel tank can be large. If you burn it wrong in the first 2 years, the size does not save you. Here's the part that never makes it into a standard retirement calculator, and I have looked at a lot of them. Knowing that sequence risk is real, that forced early retirement happens to nearly half of people, and that the first 2 years are the danger zone, knowing all of that is still only half the problem. The harder half is building a system around it before you land in that window. I know this because I built one. I spent about a year pulling apart 50 years of retirement data, not just the returns, but the withdrawal rate research, the healthcare gap numbers, the Social Security timing trade-offs, the tax drag on different account types during drawdown, and I put it into a book called The Exit Code. It is not a manifesto. It is a mathematical framework for turning "I think I might be able to retire someday" into a specific date with a specific structure. One chapter documents what I call the $14,000 invisible bill, the insurance gap that hits retirees who are under 65 and suddenly without employer coverage. It is the expense that destroys early retirement timelines more reliably than any market crash. And almost nobody models it in advance. There's also a chapter on the dynamic withdrawal method, a flexible framework that replaces the rigid 4% rule and adjusts to what the market is actually doing instead of pretending the market follows a fixed annual schedule. And a chapter on the Social Security bridge strategy, which I'll explain in a moment, that allows you to delay claiming until age 70 without going broke during the gap years. Your financial advisor will not hand you this. They charge 1% a year of your assets to explain half of it, and that 1%, compounded over 30 years on $200,000, costs you more than $170,000 in lost compounding. The exit code costs less than a dinner out through the link in the description. Every year you delay building the system, the math compounds against you, not dramatically, but quietly and permanently. This is where it gets really interesting. And by interesting, I mean genuinely alarming if you're planning to retire before 65. 70% of Americans retire before they are eligible for Medicare. Think about what that means for a moment. Most people, when they imagine retirement health insurance, picture Medicare. They've been paying into it their whole careers. It will be there. And technically, yes, but only at 65, not at 62, not at 63, not at 61 when the layoff happens. Monthly premiums of roughly $1,000 to $1,100 per person can meaningfully affect how long retirement savings last, especially when combined with other core costs such as housing, food, and transportation. That is $12,000 to $13,000 per year per person just in premiums, not deductibles, not copays, not the random $3,000 emergency room visit in year 2. Premiums alone. The premiums for a 64-year-old on the ACA marketplace can exceed 4 times the cost of most Medicare coverage at age 65. There is an additional wrinkle that just materialized in 2026 specifically. Many people qualified for a subsidy to help pay ACA premiums based on household income, but the subsidies expired at the end of 2025, and the outcome of efforts in Congress to restore them is uncertain. Those enhanced premium tax credits that made marketplace coverage manageable for the last 4 years, gone. The subsidy cliff is back. And for early retirees drawing from traditional retirement accounts, the income generated by those withdrawals can trigger a loss of subsidy eligibility that costs thousands per year in additional premiums. The withdrawal you made to pay your mortgage just made your health insurance more expensive. That is the kind of interaction that never shows up in basic retirement calculators. So picture this. You retire at 62, voluntarily or otherwise. You need 3 years of healthcare coverage before Medicare. At roughly $12,000 a year in premiums per person, that is $36,000 in insurance costs over the bridge period. $36,000. That was not in most people's retirement models, because most retirement models assume Medicare starts the day after the last paycheck. It does not. Nearly 60% of workers say medical expenses are hindering their retirement savings, while 40% of retirees reported higher than expected healthcare costs. 40%, not a fringe outcome. Nearly half of retirees are finding out in real time that they underfunded the healthcare line item. And in 2024, 31% of retirees said their spending is much higher than they can afford, up from 27% in 2022 and 17% in 2020. That trajectory is pointing in one direction. A retiree pulling $36,000 out of their portfolio over 3 years to cover insurance is not simply spending money. They're burning fuel, liquidating shares that cannot recover during the highest risk window. A portfolio of $500,000, losing $36,000 in the first 2 years, combined with a 15% market decline, can knock out a decade's worth of recovery potential. And this is not theoretical. This is the math of the fuel tank flip meeting the invisible healthcare bill. Now here's the subplot I want to weave through the second half of this video, because it explains why intelligent, financially literate people still make catastrophic decisions during the first 2 years, and it is the most underreported dimension of retirement failure. There is a story about a businessman retired after decades in a senior manufacturing role. Solid plan, good savings, did everything by the book. 6 months into retirement, he started making strange financial decisions. He moved a chunk of his portfolio into individual stocks he had been reading about online. He cashed out a piece of his IRA to renovate a room that did not need renovating. He started declining to rebalance when his advisor suggested it. Was he stupid? No. Was he irrational? Absolutely. And here is why. Research from the National Bureau of Economic Research, analyzing longitudinal data from the Health and Retirement Study spanning 1992 through 2005, found that complete retirement leads to a 6 to 9% decline in mental health over an average post-retirement period. A 2021 study published in The Gerontologist found that 41% of retirees experienced moderate to severe identity disruption within the first year of retirement. And the American Psychological Association found that 30% of retired men experienced depression symptoms within the first year, often due to the loss of professional identity and social connections. Depression and identity disruption do not stay in the psychology lane. They bleed directly into financial decision-making. The businessman buying individual stocks was not investing. He was manufacturing urgency, manufacturing the feeling of doing important work, because retirement dismantles 4 foundational pillars of psychological well-being: identity, structure, social connection, and purpose simultaneously. When those 4 pillars come down at once, the brain does something counterintuitive. It reaches for control. And in the absence of a job, financial decisions become the new arena for control. Except financial decisions made from an emotional deficit are notoriously poor. You sell during corrections because the anxiety is unbearable. You make speculative purchases because they feel like action. You pull money forward, claim Social Security early, Liquidate accounts ahead of schedule because certainty feels better than waiting, even when waiting is mathematically superior by a very large margin. One ongoing study found that retired people, especially those in the first year of retirement, are about 40% more likely to experience a heart attack or stroke than those who keep working. The psychological stress of the transition is not just emotional, it is physiological, and a stressed, identity destabilized retiree making financial decisions in the highest risk window of their financial life is the combination that quietly wrecks plans that looked fine on paper. Let me give you a specific scenario that captures everything we've covered. David is 58, senior manager at a mid-sized company in the Midwest. He and his wife Carol have saved carefully. Their combined retirement accounts hold $600,000. They own a home worth $300,000. David's plan: work until 65, retire with an $850,000 portfolio, draw 4% a year, $34,000, supplemented by Social Security. They will both claim at 67. Clean, reasonable. At 62, David's company announces a restructuring. He is offered a package. He takes it, or rather, the package is structured in a way where refusing means a worse outcome. He retires 4 years ahead of schedule with a $620,000 portfolio because the market had a rough year on the way out. First problem: healthcare. David is 62. Medicare is 3 years away. His wife is 59, 6 years away. They need coverage. The marketplace premium for a 62 and 59-year-old couple in 2026, with the ACA subsidy cliff reinstated, runs roughly $2,200 per month based on their income from retirement account withdrawals. That is $26,400 per year before a single copay. In year one, David and Carol spend $91,000 normal living costs plus insurance against a portfolio that dropped 8% in the first 12 months because they retired into the beginning of a correction. The portfolio is now down to $540,000 after distributions and market losses combined. Year two is flat to slightly positive in the market, but they still need the same cash. Portfolio ends year two at approximately $480,000. They are 2 years into retirement. Their portfolio has dropped from $620,000 to $480,000, a 23% decline in real value, not counting market performance. Their original plan assumed a starting portfolio of $850,000. The gap between what David planned and what he is living is roughly $370,000. That gap compounds against them for every remaining year. David has three options. He can dramatically reduce spending, which means abandoning the retirement he and Carol planned. He can claim Social Security at 62, taking a 30% permanent reduction in monthly benefits for the rest of his life. Or he can go back to work in a market that does not especially want a 62-year-old in his specific role. Only 4% of retirees actually wait until 70 to file for Social Security benefits. Most people facing exactly David's situation claim early. And a permanent 30% reduction on a Social Security check that was supposed to last 30 years is not a small decision. That permanent haircut over a 30-year retirement likely represents more than $200,000 in foregone lifetime income. This is the domino chain of the first 2 years. One early retirement, 1 year of market weakness, one healthcare bill that was not modeled, and the entire plan restructures itself around an inferior outcome. I want to be clear. Financial advisors have been aware of sequence risk since at least the 90s. The solution they typically offer? Make sure you have a diversified portfolio. Thanks. I'll file that next to make sure you eat healthy and try not to get sick. Extremely helpful, genuinely actionable. Now, the 4% rule. I need to address this because it is the retirement planning equivalent of a GPS that works great in city driving and then confidently routes you into a lake. Bill Bengen created the 4% rule in 1994. The idea? Withdraw 4% of your portfolio in year one, adjust for inflation annually, and your money should last 30 years. The rule was backtested to 1926. Even if you had retired in 1929, a diversified portfolio with 60% US stocks and 40% bonds would have lasted at least 30 years if you withdrew an inflation-adjusted 4% per year. Sounds bulletproof. Here is what it looks like in the actual world. From 2000 to 2013, the market experienced two major crashes, the dot-com bust and the Great Recession. And even though there were recoveries in between, equity returns over that entire 13-year period were essentially flat. Using a 4% withdrawal rate, a retiree who started with $1 million in 2000 would have had just over $700,000 left by 2013. $700,000 on a $1 million starting portfolio after 13 years of withdrawals. That retiree has locked in a trajectory that severely threatens their ability to make it to year 30. And they followed the rule exactly. Wade Pfau, one of the leading researchers on retirement income, has assessed that there's something like a 65 to 70% chance that the 4% rule works for today's retirees rather than being a near certainty, placing the actual safe withdrawal rate closer to 3%. 3% on $500,000, approximately the median portfolio for Americans in their 60s. 3% is $15,000 per year before taxes. That is not the retirement people planned for. And it is not the retirement the 4% rule promised. The problem with the 4% rule is that it was designed for a specific bond yield environment that no longer exists in the same way. It was not designed for people who retire at 62 instead of 65. It was not designed for people who might live to 95. It was not designed for portfolio sizes at the median. And it was absolutely not designed for the sequence risk reality that a bad first 2 years collapses the math in a way that averages never reveal. The mainstream financial planning establishment knows this. The reason it has not been broadly communicated is incentive-based. A 1% annual advisory fee on a $500,000 portfolio is $5,000 per year. Over 30 years, compounded, that fee costs the client roughly $170,000 in lost growth. The incentive is to keep you in a comfortable, simple framework, the 4% rule, max your 401k, see you next year, rather than build the slightly more complex dynamic system that would actually protect you in the launch window. That is not a conspiracy. That is how incentives work. Amused disappointment, not outrage. Here is something I find genuinely charming. Maximizing your retirement date flexibility is what financial advisors call having a backup plan for when you get laid off at 62. They reframed an involuntary exit as a planning opportunity. Bold work, very reassuring. So here is what you actually do. 3 specific defenses of the launch window. The first defense is the fuel buffer. Before you flip the tank, before you retire, you build a cash and short-term bond reserve that covers 2 to 3 years of essential living expenses. Not total spend. Essential spend. The amount you need, even if the market is down 30% and you are not willing to sell equities. A retiree, starting with a $1 million portfolio in February 2020, built a 2-year cash buffer of $80,000 in cash equivalents. While equities dropped 34% by March 23rd, the fastest bear market entry in 90+ years, the cash strategy proved highly effective. By avoiding equity sales during the trough, the portfolio recovered to its peak by June 2020. By end of 2023, the portfolio reached approximately 1.25 million, despite the severe entry timing. The buffer does not eliminate sequence risk. It buys time. It gives the equity portion of your portfolio the one thing it needs most to survive a crash, the ability to not be sold at the bottom. 2 to 3 years of cash gives you the runway to let markets recover before you have to start liquidating. The second defense is dynamic withdrawal. You do not commit in advance to withdrawing a fixed percentage every year. Your withdrawal rate responds to what the portfolio is actually doing. If the market is down in year 1, you cut discretionary spending. If it is up, you might give yourself a modest raise. Dynamic withdrawal approaches adjust spending based on portfolio performance, substantially reducing sequence risk. Recent modeling shows flexible strategies boost success from near 0% at 5 to 6% initial rates to near 100% in historical scenarios, far exceeding rigid 4% safe withdrawal rates that leave massive excess wealth in favorable sequences. The rigid rule gives you false certainty. The flexible approach gives you actual survival odds. The third defense is Social Security timing. Most people facing cash pressure in early retirement claim Social Security immediately. Workers can file for benefits as early as age 62, but the trade-off is a roughly 30% reduction in their monthly checks compared with waiting until full retirement age. On the other side, waiting until age 70, the maximum age to claim, provides a boost of more than 30% to one's monthly benefits. The strategy, if you retire early but have portfolio assets to bridge with, is to delay Social Security as long as your situation allows, while drawing down from retirement accounts first. Every year you delay past full retirement age adds roughly 8% to your annual benefit for life. For a benefit of $2,400 a month at 67, waiting to 70 gives you roughly $3,100 a month instead. That extra $700 a month over a 30-year retirement is $252,000 in additional lifetime income. $252,000 guaranteed, inflation adjusted, for the rest of your life. Only 4% of retirees actually wait until 70 to file. That is the trade the 96% are leaving on the table. Back to our businessman, the one making erratic financial decisions in year one. Here is how that story ends. He found two things that replaced what work had been providing without him realizing it. He started mentoring young entrepreneurs through a local business organization, which gave him structure, a calendar, a reason to prepare, and an audience who cared what he thought. And he took a very limited consulting role with a former competitor, which brought in a small but psychologically significant income. Not because he needed the money, because it allowed him to stop thinking of himself as someone consuming a portfolio and start thinking of himself as someone still contributing, still useful, still in the game. Research from the National Bureau of Economic Research found that complete retirement leads to a 6 to 9% decline in mental health. The word complete is doing a lot of work in that sentence. Partial engagement, mentoring, consulting, serious volunteering appears to maintain the identity scaffolding that prevents the psychological decline from compounding into financial damage. And a psychologically stable retiree makes categorically better financial decisions in the critical window. Once the identity crisis resolved, about 14 months in, he stopped the erratic trading. He stopped pulling money forward. He started working with his advisor from a place of clarity instead of anxiety. His portfolio recovered faster as a result. Not because of the market, because he stopped making expensive decisions from a panicked brain. The fuel tank flip is not just a financial event, it is a psychological one. And the ones who navigate it successfully understand that both need to be planned for, separately and in advance. Let's come back to where we started. Two people, identical portfolios, same average returns. One thrives, one goes broke. The difference was not intelligence, discipline, or strategy. It was timing. Specifically, the timing of bad returns relative to the moment of the fuel tank flip. Three things you can actually do with this. Number one, model two retirement dates. Model the one you want and model one that is 3 to 5 years earlier, because 46% of those who retired in 2025 stopped earlier than planned. Run both scenarios. If the forced early version is catastrophic in your model, your plan has a hidden vulnerability. Fix it before the layoff arrives, because the layoff does not give you advance notice. Number two, build the cash buffer before you need it. 2 years of essential living expenses in cash or short duration bonds held outside your equity portfolio changes your sequence risk exposure from extreme to manageable. It costs you some growth during the accumulation years. It buys you the ability to survive a bad launch window. That is an asymmetric trade in your favor, a small sacrifice for a large insurance policy on the most dangerous 2 years of your financial life. Number three, do not default to Social Security at 62. If you leave the workforce early, voluntarily or otherwise, the instinct is to activate every income stream immediately. Resist that instinct for Social Security specifically. Pull from your portfolio first, delay Social Security as long as your situation allows, and let the 8% per year of delay credit compound. The difference between claiming at 62 and waiting until 70 is the largest guaranteed return available to a retiree in this country, and it is permanent. Lazy investing built more fortune than crypto memes. And if you're still trusting a static withdrawal rate modeled on 1994 bond yields to carry you through a 30-year retirement in a fundamentally different economic environment that is not a plan, that is a hope dressed up as math. And hope, unlike compound interest, does not work in your favor.